Wow, I am completely shocked. Ladies and gentlemen, this is a massive video. Now, I know I throw terminology like that around quite often, but this individual controls 30% of all the trading that happens in the markets. This is not your random billionaire. And he just gave you a massive warning about the markets. So you really need to hear that, and I want to provide you guys a little bit of clarity on just why this is so important. Take it a little bit further. On top of that, tomorrow is quad witching, so I think in that regard we need to talk about what we can expect. As well as that, we have an auto strike that could start in just the next couple of hours. What are the implications there? How could that affect Tesla positively, maybe negatively, as well as the broader markets? And we do have some economic data coming out tomorrow, which could also be important. So this is a jam-packed video, kind of all over the place, and it's kind of rounded on the same topic. So hopefully you guys like this one. If you're invested in Tesla, if you like these kind of videos, hit that like button, as well as subscribe to the channel to stay up to date with all of this information. And the goal of this information is, number one, keep you up to speed and up to date on what's happening out there with Tesla and the broader markets, but also to help you make money. This video will either make you a lot of money if you hedge out your portfolio, if you trade this correctly, or it will help you save potentially a lot of money.
Let's get back to our Sarah Eisen with Citadel's Ken Griffin. Sarah.
Hi, thank you, Carl. And I am here with Ken Griffin, founder of Citadel. It's good to see you here at Success Academy, which I know you want to talk about. Thank you for joining us.
It's great to be here today.
We're going to talk about education and why success in a moment. But first, big markets day for us, big IPO day. The folks were just talking about ARM. Do you look at ARM, which is the biggest debut in a couple of years, as a sentiment barometer? How do you look at IPOs and what they signal about where we are in the market?
I mean, so clearly the ARM transaction is a sentiment barometer. The very fact the deal's coming to market today tells you there's a perception that our capital markets are reopening for IPOs. And I really hope this is a deal that goes off very well today. We need to see all of the VC-backed companies of the last decade have that opportunity to go to our public markets to raise capital so that the founders have an opportunity to continue to grow their businesses and grow our economy.
It's been a surprisingly good year for the markets and the economy, which I think is reflected in the fact that they're going public. Question, Ken, is what comes next?
So actually, I would agree with you. It's been a really good year for the market, particularly with the backdrop of higher real interest rates. So if you look at both the yield on the 10-year bond and, more importantly, the real yield, for example, in the 5-year TIPS bonds, we've seen, again, an increase in real rates and nominal rates, and yet the stock market's been resilient. So that's a really interesting year to see the resiliency of our stock market against this backdrop that would usually be very challenging for equities.
Think it can continue?
I'm a bit anxious that this rally can continue. You know, obviously, one of the big drivers of the rally has been the just frenzy over generative AI, which has powered many of the big tech stocks. I like to believe that this rally has legs. I'm a bit anxious. We're sort of in the 7th or 8th inning of this rally.
Well, part of it has been the soft landing story. Are you a buyer of that? The fact that we just haven't gone into recession despite 525 basis points of tightening.
So it takes about a year to 2 years for an interest rate hike to work its way through the economy. It's not instantaneous. We're now at the point where we're going to see the impact of these hikes really start to play out. We're seeing the job market starting to weaken. There's been a number of news stories in recent weeks about how companies are willing to pull back what they're paying for starting roles. We're seeing signs that consumers have had enough in terms of price increases, that they're starting to walk away from products they're trying to push through price increases. So there's signs here that we're heading very quickly into hopefully the soft landing, potentially a more difficult scenario moving into mid to late last year in terms of an actual recession.
Let me tell you in English, in common sense language, what he just said. You do not very quickly head into a soft landing. That was him kind of digging himself into a hole, trying to create an outlet here. I don't think he meant to come off as strong as he did and really express how he is feeling or seeing things out there. He basically said we're very quickly heading into a recession. Now, for those of you guys that don't know who this individual is, this is Ken Griffin. He owns the most expensive house in Florida. He's a like 30 plus billionaire. But he also runs Citadel, the market maker, and Citadel, the hedge fund. A lot of people don't like Ken Griffin. I don't care. Leave the politics out of it. This guy is by far one of the most interconnected individuals in financial markets today. If there's anyone out there that knows there's a problem and is preparing for it, it's Ken Griffin. It's Citadel. It's the market maker. And let me explain exactly why. Well, to understand this, let's go back in history quite a few years to 1987. October 19th of 1987 came to be known as Black Monday. This was a day of infamy on Wall Street when steep and unexpected sell-offs devastated global markets. These sell-offs reached a frantic crescendo in the matter of hours, triggering a massive stock market crash. The markets actually closed down over 20% this day. Do you guys remember the Rona crash where you actually had the markets get halted twice? The markets first get halted at 7% and then for 15 minutes, and then the markets get halted at 10% for 15 minutes. I don't know if we'll ever see that again in our lifetime. That was definitely a moment for history if you lived or were investing during the 2020 crash. But what happened in 1987 was the market makers refused to buy stock. So ever since 1987, it has become even more important for market makers to have a full understanding on what's going on, and in bad times to have more capital, or risky periods of the markets to have more capital on hand, and maybe in less risky times to have less capital on hand. For an example, during 2021, when stocks were going crazy, sure, there was a chance COVID could come back. Interest rates were at zero. The Fed was literally giving out billions of dollars, the government, like every single week. There wasn't a whole lot of risk in that market. Today is a lot different. And I think it's safe to say Ken Griffin, Citadel, which controls about 30% of all of the shares that trade hands on the markets, has a pretty good understanding of what hedge funds are doing as far as hedging their positions, what CEOs are doing, the insights of business. Think about it like this. If the US government got word that China was going to officially ban all US companies or officially ban Apple, well, that could be a really bad event for the markets. You don't think the government would call up Citadel and the rest of the market makers and let them know we could have a big problem on our hands? Be ready, make sure you have the capital to backstop the markets? You don't think that would happen? They're the most interconnected individuals in financial markets. And specifically with Ken Griffin, if you like him or not, I don't care. Again, keep the politics out of it. He does not talk negatively about the markets all too often. Whenever he does speak, which is, again, not that often, he usually has good things to say. That the markets are fine. He's usually pretty bullish on the markets. Again, you only hear from him like twice a year, if that. So you don't hear from him too often. But anytime I've heard from him, he didn't sound like this. And we know there's problems out there. But this is really a stark contrast of language that you're just not hearing from anyone else. And again, this is the guy that would know if we're heading into a problem in the markets. Now, let me point out the obvious. Nobody can predict the markets and actually what's going to happen. But if there was anyone that could or would know what's going to happen, again, it would be Ken Griffin. Now, I do want to talk about quad witching. Now, quad witching is tomorrow. And we've looked at this chart many times. I'll just go through a quick explainer if you have not seen this yet. This is the chart of the S&P 500 for the month of September, obviously averaged out the return from 1950 through 2021. What do you notice here? After quad witching, the third Friday of September, every time you get quad witching, which is this Friday, well, you tend to pretty aggressively sell off into the end of September. The first half of September actually tends to be pretty bullish. And this week we're in right now, CPI was the 13th, that's kind of right here. Today was the 14th, kind of right here. I mean, even tomorrow, historically, could be a pretty strong day. It's next week and the week after that where you can see a problem. Now, next week, you're going to have Fed Jerome Powell, you're going to have some other data points, and that could be an issue for the markets. We'll obviously have to wait and see. I can't forecast what the markets are going to do next week, but I will tell you, quad witching, historically speaking, does not tend to be any more bullish or any more bearish than any other day in the markets. You do tend to see more volume because you have 4 different derivative classes that are expiring worth trillions of dollars that people either sell out of those derivatives, buy new ones, exercise their contracts, or just outright hedge out their portfolios. There's a lot of money that's moving around on these quad witching days. And presumably the reallocation of this money could cause the sell-off. Another important thing to point out is that October is the end of a lot of hedge funds' calendar years. So that means you kind of got to shore up your books. You got to get more capital on hand, maybe sell some stocks before you actually get into October. And that's one of the kind of biggest long-standing theories on why September tends to be the worst month in the markets, and then October tends to be one of the best months in the market. It makes sense if the calendar year starts in October and ends in September. That could obviously play a role into seasonality. You never know what's going to happen, but this is pretty obvious. You tend to see the same thing almost every single year. Now, as far as any larger potential crash, obviously, who knows? I'm sure that would be due to some form of recession or just fears of going into a recession. October 26th is going to be the Q3 GDP report. Right now, the estimate's around 3%. So I do think there is some room for stocks to come down as estimates do fall heading into October 26th. But I don't know if that's going to give you the actual crash event or if it's some point in 2024. So as you guys know, we are heading into the first potential UAW strike since 2019. And the Ford CEO just said that they have not received a counter offer from the UAW, and you only have just a couple of hours left until midnight, and the first strike could start. He goes on to say that you would expect or you would think they're in a room hardcore negotiating, but they have actually not heard anything from the UAW, so it looks like the UAW has just made up their mind that they're going to strike. This could cost the economy about $1.8 billion if all 3 automakers do strike, which looks likely at this point, every single week. This would include less that workers are making, the 140,000 workers that would be going on strike, as well as the lack of revenue the automakers would be bringing in. That would definitely start to have a pretty significant impact basically right away. GM has a new counteroffer of a 20% wage increase over the life of the agreement, with a double-digit 10% increase in year 1. Inflation protection, I wouldn't expect that to be too impactful. Faster path to max wages. progression steps cut in half to 4 years, job security, better health care, retirement security, $500 to retirees, $1,000 to active employee defined benefit program, work-life balance. They will get Juneteenth off, 2 weeks of paid parental leave, and up to 5 weeks of vacation, not the 32-hour work week that the UAW is asking for right now. GM does write in their letter, "We continue to bargain in good faith, but with our contract set to expire at 11:59 p.m., I want to make sure you are completely informed. We know a strong GM is important to all of us. We are working with urgency and have proposed yet another increasingly strong offer with the goal of reaching an agreement tonight. Remember, we had a strike in 2019 and nobody won. Our record offer includes," and that's exactly it, a record offer. Now, this would have pretty immediate impacts as well to the economy. Now, I live in Michigan, so a lot of people I know work specifically at GM. Some people work at Ford, but most of them work at GM, at least the people that I know. And back in 2019, well, the plants in Michigan were some of the ones that actually did strike. So it looks like they want to do like a phase strike, like kind of putting the pressure on the auto industry, having strategic strikes at different plants. But that would probably escalate pretty quickly into a full-on strike of basically all of them, all of the plants, or at least the plants that are actually unionized. So this would not be great. And just add that on top of everything else that's going on in the economy, and it could be a tipping point. It could really be an event for the markets. Now, when you guys think about a recession, usually a recession happens by some big event. I don't know if this this union strike could be that big event to really push things into a recession. If this did last a while, then sure, that could obviously be it. But you also have student loan repayments that kick in. You also have the Fed probably going to raise rates again in November. There's a lot of different things, including the banking crisis, that just set us up for a really risky period in the market. Elon Musk says, "Walter spent a lot of time with me in meetings, but much less time walking the factory floor. Tesla and SpaceX factories have a great vibe. We encourage playing music and having some fun. Very important for people to look forward to coming to work. We pay more than the UAW, by the way, but performance expectations are also higher. Quite a few of our factory techs who work on the line have become millionaires over the years from company stock grants." So really just throwing a jab out there at the UAW. So about 1 hour after this video is posted, we're going to be getting industrial production year over year, retail sales year over year, and the unemployment rate for China coming out at 10 p.m. This video should be posted around 9 p.m. Overall, you're expecting things to have improved from last month's numbers. Basically across the board, besides the unemployment rate is expected to tick up by 0.1%. If you get a big move up or down, markets will react to that, and that would be negative. I don't know if that's going to happen. I'm not going to sit here and try to forecast that's going to happen. But if it does, well, that's why the futures are going to be up a lot or down a lot in the event we do get a big miss or big beat to the Chinese data. The second largest economy in the world is important, whether you would like to believe so or not. Now, the data that we're going to be getting for tomorrow is export prices, import prices, industrial production year over year and month over month, manufacturing production year over year and month over month, capacity utilization, all of that data coming out in between 8:30 and 9:15 in the morning tomorrow. And then at 10 a.m. tomorrow Eastern Standard Time, you're going to get the Michigan Consumer Sentiment Survey. Now, you're expecting basically everything to fall a little bit as far as the actual number here, and a lot of this has to do with the markets. They tend to follow each other, but the thing that really matters is the 5-year inflation expectation. Specifically, you're expecting that at 3%. If that does increase, you're going to have a problem. Now, the lows that we hit was back here when the markets were falling in September and October of 2022, when inflation was much higher than it is today. And your 5-year inflation expectation was 2.7%. If this goes higher than 3.2%, well, you're going to be at a new high for the past 15 years, the last 20 years. If you go higher than 3.4%, which is very unlikely, you're going to be at the highest point since right before the global financial crisis. And that would be bad. That whole speech that Fed Jerome Powell gives every time he raises rates and gets on the podium and gives us the FOMC press conference of inflation expectations are well anchored, well, this is part of what he's talking about. So you don't want to see inflation expectations rise. As you can see, we were falling quite a bit towards the end of 2022, and you've rebounded right back up to the highest levels that we have been at in this whole rate hiking cycle. And this theoretically should not happen after rates have been hiked from 0 to almost 5.5%. Just should not be happening. So any higher on your 5-year inflation expectations, going to be quite negative. Your 1-year inflation expectations are expected at 3.5%. So this has been falling, right? Obviously, as inflation has been falling, the price of gas has been falling. This 1-year inflation expectation, as you can see, not nearly as important. It's basically down to where it was at the start of the round of inflation back in like end of 2020. So it's the 5-year inflation expectation that really matters to the markets. And just look at these charts in context. This is the 1-year. You've fallen right back down. The 5-year fell a little bit, and now you're still, like I said, right up here towards the highs. This is what you want to be watching for coming at 10 a.m. tomorrow. This could be a data point, if it's really bad, that could also affect the markets very negatively. And just for those of you guys that made it to the end of this video, if you did not watch the last video that was put out, I highly recommend you do. But we basically talked about this downtrending level of resistance, the fact that we have now broken and closed above it for the first time in basically 2 years if you take out right here before earnings last time around, which was right before earnings. I don't think this really counts nearly as much as right now. You're at a real kind of breakout moment for Tesla stock. As long as nothing goes to hell in the markets, then you could see Tesla very quickly go through a pretty strong rally. 315 is my next target, in which, if all hell doesn't break loose in the next 2-3 weeks or so, that is what I would be expecting. Tesla stock closed up 1.75% today at $276.04 per share. Even in after hours, moving up 0.32%. And maybe these auto strikes are having or will have a positive effect on Tesla. We'll obviously have to wait and see how that all shakes out. There's been different commentary across the board, whether it's good or bad. I think that's pretty well known. It's probably a net positive for Tesla, but we don't know. Maybe the markets sell off all the auto stocks. We just don't know. Or maybe Tesla performs very well, as you can see, right before the deadline and potentially getting the first auto strikes in the last 4 years. Tesla stock, again, is up 0.34% here in after hours, seeing a very strong move, up about $1 in after hours, right at about $277 per share. So that is going to do it for this video. Hopefully you learned something. If you did, well, like the video as well as subscribe to the channel to stay up to date with all of this information every single day. And hopefully this video helps you make some money and really understand what's going on out there. When Ken Griffin says that we're very quickly going into recession, I don't think you can really argue that, like, at all. I'm not going to sit there and argue that. When he sees and really controls 30% of the flows in the market, yeah, count me out of that argument. So that's going to do it. If you guys want to come trade with us, come hedge out your portfolios live in real time. I send out my trade alerts. Link down below in the description of this video. My name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.